What's up everyone? What's happening lately to the US is going to have a strong impact and it's going to affect all of us investors in the years to come. Moody's has downgraded the credit rating of the US, the dollar is losing more and more against most major currencies, and the US national debt is getting dangerously close to $37 trillion, which is bringing the interest payment of the US government to an all-time high. So if you invest in a stock market, for the United States, there are going to be consequences that we can't blindly ignore anymore. But if you're ready and you know how to act, you can protect yourself from every possible negative outcome and even come out much wealthier than before. So today we're going to talk about exactly what's happening, what it means for you as an investor, and what you can do to make the best out of this difficult situation. And before starting this video, I know it's annoying to ask or to hear this, but my channel is still so small after 3 long years of work, so I'd appreciate it so much if you could subscribe and drop a like to this video. It would really mean the world to me. Now we've got 2 major problems that we're gonna talk about today, and then we'll talk about the solutions. As you might have heard, the US has lost its AAA credit rating by decision of the Moody's agency. And important institutions like JP Chase, Bank of America, and Wells Fargo have also been downgraded a few days later. The credit rating has always been one of the most important proofs of American financial dominance over the world, because a credit rating tells everything about the ability of a country or company to fulfill its financial obligations. In simple words, to pay back its debt on time. So now we get to the US, because the US, as you may know, has a notorious problem with the spending deficit or budget deficit. Namely, the government spends every year more than it earns from taxes, and to cover this deficit, one of the ways it has been to issue more and more treasury bonds. So the US sells the bonds, other countries or institutions buy them, and the US basically builds debt towards them and needs to pay it back every year with interest. As of today, the debt almost reached $37 billion, which is higher than the total GDP of the whole country. And this year, the US is on track to paying more than $1.2 trillion on interest payments alone, causing the US to pay 18.4% of the total federal revenue only in interest payment. The situation becomes even more critical if you consider that Moody's expects the federal interest payments to absorb around 30% of revenue by 2045. Think about it. Imagine you're earning $100,000 per year, and every year you spend $30,000 only on interest payments on your credit cards. I mean, not even Dave Ramsey could save you from that.
This is nuts! It's nuts! It's completely out of control.
Now, as Ray Dalio believes, instead of the American first approach that we're taking, if the US wants to survive and thrive in the long term, the best approach should be a multilateral cooperative world order. But this is not happening in the current global environment in which the US threatens every country with extremely high tariffs and screams America first at every corner. Now that Moody's has downgraded the US credit rating from AAA to AA1, the US is, to the eyes of the world, less trustworthy than before. And Moody is not the first agency to downgrade the US. There are 4 famous global credit rating companies, and you can see it in this table together with the rating scales they use. We have Moody's, Standard & Poor's, Fitch, and Morningstar DBRS. Already in 2011, S&P downgraded the US rating to AA+ with negative outlook. And on the 16th of May this year, also Moody's downgraded it from AAA negative to AA1 stable. The 4th agency, Fitch, also downgraded the US from AAA to AA+ in August 2023. It's clear that now, because of the downgrade by Moody's, the US is seen as less trustworthy than before. So now, when the government needs money and issues treasury bonds, it's harder for it to sell these bonds. Imagine you have a neighbor that every year asks you for money and he pays you back with 5% interest. If one day a friend of yours comes to you and says, "Hey, that neighbor is having financial problems and he might have trouble paying you back in the future," what would you do if the neighbor comes and asks you for money? Would you keep lending him money? Maybe yes, but instead of 5% interest, maybe you'd request 20%, because if you're risking more, you also want to have more return. Being downgraded is for sure going to negatively impact the US economy and credibility. There is no doubt about that. How much, and is it going to be for the long term? This is the question. Now, the bond market is a really important market to know if you want to really understand even the stock market. Thanks to the bond market, you can understand the development of a country, and with it, also what's going to happen to the stock market. The reason is that the bond market is the backbone of all markets. The interest rate that the US gives in its bond market is the risk-free interest rate, or default-free interest rate that determines what all assets returns are going to be. The lower this rate is, and the more people are going to be ready to invest in the stock market because their expected return is much higher than the risk-free rate. But if the risk-free rate of the bond market is high, let's say 9%, then people would say, why would I risk investing in the stock market just to make maybe 1% more if I can get 9% risk-free from the bonds? So you see how the bond market influences the stock market. Well, the situation is even more complicated, because if the US is downgraded, then countries that buy our bonds are going to wonder, am I really gonna get this return risk-free? Or is there a risk that the country defaults and doesn't pay me back? So what happens now with the downgrade of the US credit rating is that there is going to be a breakdown of supply and demand for the American bond market. The government is going to need to issue more bonds because they need money to cover the deficit. But institutions and other countries are going to be more reluctant to buy them because the risk of the US defaulting and not paying its debts is higher. When there is this imbalance between supply and demand for bonds, this is what you usually see and what you're actually seeing now. You see long rates rising relative to short rates. You see the currency go down, like the dollar is doing. You see gold go up. You see Bitcoin go up. This is because there is a movement out of the bond market into other assets. So interest rates of the bond market grow, and now the Federal Reserve in the US has a really difficult decision to make. Yes, because it's a Federal Reserve that needs to save our asses in this case. They can either allow the government to raise the interest rates of its bonds, which is going to make them more attractive for investors, but it's also going to dangerously increase the debt of the United States, or they can print dollars and buy the bonds themselves, covering from the lack of demand from the rest of the world. This allows the interest rates to remain low, but at the same time creates inflation, because the dollar loses more and more value because of the printing. So as you can see, there is no good outlook for the situation. And that's why when Trump was kind of forcing the Federal Reserve Chairman Jerome Powell to lower interest rates, I was like, Trump, let the Federal Reserve do their job. They know what they're doing. KKR, a global investment firm with over 360 billion in assets under management, said that the US treasuries or bonds are no longer an effective hedge against risk assets. Henry McVeigh, their head of global macro and asset allocation, reportedly said that government bonds are no longer fulfilling their role as the shock absorbers in a traditional portfolio. Many CIOs are considering moving assets out of the United States towards other parts of the world. He also said that the US dollar is about 15% overvalued and that a weaker greenback is most likely approaching as President Trump's new trade agenda develops. You can see that the bonds problem is a serious one. So why does it all matter for us? Lower credit ratings, like the one Moody's just gave, typically lead to higher bond yields, which will raise interest rates on everything from mortgages to car loans to credit card debt, because commercial banks use government bond yields as a basis for setting their own interest rates. This is crucial for Americans because they are among the most highly indebted people in the world. If the US government continues to spend more on rising debt repayments, it will have less for public spending on things like social security, healthcare, and defense, as it becomes more expensive for the government to sustain itself. So what can you do as an investor to make the best out of this difficult situation and possibly put yourself in a position where not only you don't lose money, but you actually make a profit? The first most important thing is don't hold too much cash. Keep the amount of cash that is necessary for you, and this usually is around 6 months worth of expenses as an emergency fund. The rest is better invested than in cash, because whatever happens to the economy in the years to come, one thing is sure: inflation is a constant outcome of unstable markets, and the Fed will have to print more and more money to bail out America, because in inflation they will keep consuming the buying power of your cash. The second suggestion for me is, now more than ever, diversifying is important. I've always been a strong believer in the United States' economic power. I've always invested in the S&P 500 and gave full trust to the American economy, just as Warren Buffett always preaches. But we, investors, can't be blind to the fact that since decades, the fiscal situation of the United States has been growing weaker. Yes, the US has established itself as a global leader in technology, but the trend of the deficit, the ever-growing debt, and the deterioration of the credibility that we are seeing today since decades can't be ignored anymore. To try to compensate for this, make this decision to diversify worldwide. Put yourself in a position that if the situation gets worse and the United States crosses that line of no return that no measure can fix, you are diversified with the rest of the world. Does it mean that the United States will surely underperform in the future? No. Nothing is sure in this world. It just means that you're hedging the risk of that happening. If you invest from the US, a good idea is to invest in VXUS, the Vanguard Total International Stock Index Fund ETF. This ETF gives you access to a broad range of international stocks from developed and emerging markets outside the United States, covering thousands of companies across Europe, Pacific, Canada, and emerging economies like China, Brazil, and India. It's a cost-effective way to globally diversify your portfolio beyond the US borders with a low expense ratio and exposure to both large and mid-cap stocks. If you're investing from Europe, a good alternative is the Vanguard FTSE All World UCI ITS ETF. Third important point is now, more than ever, you need a long-term approach to investing. Remember that during a bull market, you can allow yourself to invest and then sell after a year making a profit, but in an unstable market and unstable situation like the one we're going to face in the next years, there is no certainty that your investment is going to return a profit in the short term. So invest with a long-term mindset and realize that if you want to survive and thrive as an investor in an unstable market, time is the only guarantee of success you have. Point number 4, stay out of dangerous investments, because in dangerous times like this, on the internet, scammers and gurus pop up from every hole and start promising you great returns that you can fall for. So what are these dangerous investments you must avoid? Margin trading, options trading, day trading, which is the most advertised scam by finance scammers, leverage ETFs, penny stocks, Forex, and yes, even though Bitcoin is an all-time high right now, avoid investing too much in cryptocurrencies. Remember that the best time to invest in Bitcoin was a couple of years back when it was trading at $25,000 after the crash, not now that it's at an all-time high after 2 years of bull market. And if you do invest in cryptocurrencies, only choose the most important ones, like Bitcoin or Ethereum, and invest only a small sum that you're ready to lose in case the crypto market crashes again, as it will surely do at some point. Point number 5, to protect yourself, invest every month your extra cash with the dollar cost averaging method. Invest the same amount every month regardless of what the market is doing. This is by far the best way to invest, and it's been proved over and over that you achieve better long-term returns with DCA, dollar cost averaging, than by trying to time the market. And point number 6, remember that your income is still your best wealth building vehicle. Of course, if you're an entrepreneur, it's going to be your business. But for most people, the income from your regular job is how you build wealth. So you need to make sure that you have a stable income, and if you believe that there is a chance of you losing your job, you need to act in advance by making sure that you have the right skill set, by searching for other jobs, or by making sure that you're making extra income from side jobs. Now, point number 7, last point, but also a really important one, these are times in which you need to be ready to make sacrifices, and not after something bad happens, but long before. So you need to make sure to not waste money on stuff you don't really need, because if you live month by month spending all you have and investing just a small part of your income, when the day will come that the portfolio crashes and you have an emergency, you're not going to have an option that doesn't harm you. And finally, let me say this. We are not here to create drama or make doomsday predictions. But even if the US is still one of the greatest powers in the world, with China as a close second, this recent downgrade by Moody's reminds us that as investors, we can't keep taking the US fiscal stability for granted. By diversifying globally and doing all that I've mentioned here, you might possibly reduce your total return, but you reduce also your dependence on a single economy and gain exposure to regions that may outperform in the future, above all Asia and emerging markets. It's not about abandoning the US, it's about building a more resilient, balanced portfolio that can make you sleep at night, even if the US were to fall into a drastic, inevitable crash. For today, it's all, my fellow investors. Subscribe to the channel if you haven't done it already, and I'll see you in the next video. Ciao!